Welcome to everybody, wherever you're joining us from around the world today. 2020 was an extraordinary year for the world, and particularly for transport infrastructure. Some companies fared better in this difficult environment than others, and very pleased today to be joined by two world-class operators. We want to talk about how they showed resilience through the last 12 months, which of course been very challenging. How they can make use of this crisis and come out stronger on the other side, and perhaps work with governments and communities to set up the next decade of opportunity going forward. So Jean-Jacques Ruest from CN, thank you for joining us this morning.
Thank you. And you can just call me.
Yeah. And Henry Byrne, Group Executive of Transurban, thank you for joining us.
Thanks for having me.
Cool. So I want to start with something that we challenge our own team at First Sentier in regards to, is what we call the 3-minute pitch. So what I'd like each of you to do, first JJ, is answer 3 quick questions. What problem is your company trying to solve? What is your strategy to achieve this? And how do you do it differently?
Yeah, so let me just say a few words first. Thank you for having us today. Very pleased to be able to join all of the people participants, which I understand are quite a bit around the world. So CN is a railroad, freight railroad. We are Canadian from our origin, but through acquisition, we became a North American business. And everything we do, 99% is about freight. So the opportunity that we have and the challenge we try to resolve is moving the economy, the North American economy, and moving trade and enabling trade. A lot of focus on supply chain, a lot of focus on the port business, a lot of focus on the economy of the future, which more and more has to do with the consumers. And as any advanced economy, the North American economy is more and more a service economy, where people actually earn a good living of which allows them to consume, but not necessarily to manufacture or do a natural resource. So more and more of our book of business is following the consumer and what they consume, and where it typically comes from very long distance, or it comes from abroad, it comes from other continent. And that's going to be one of the very part of our future. Rail business are very infrastructure heavy. In Canada and the United States, you own your asset. They're not leased asset. They're not franchised, which are leased by the government. You own your assets, so it's capital incentive. The barrier to entry because of that is very high, because you can't get these strip of land anymore that goes from coast to coast to coast via big cities. And what we do is essential the economy. And the proof of that was really during COVID. Of our 25,000 employees, I would say about 19,000 never really stopped coming to work, physically to work, because what they do is required to restock the shelf of what we consume every day. And also their work is required to bring natural resource to the port, and also move manufactured goods to where whoever needs them. So we have an essential services that during the COVID, because COVID was mostly about the service side of the freight transportation, we remained very relevant during that period of time, even though one of the challenge was really to keep our employee very safe during that. So we had to go through a lot of hoops early days. How do we deal with that? How do we keep our employees safe? Some of them work together in fairly close proximity. Where do we get the equipment to do that? I actually, at some point, early days, we were actually making the mix and we were making some of the stuff that we needed because we couldn't buy it right away. So safety is always a big part of the concern in COVID time or pre-COVID time. But freight transportation is basically essential to the economy, and that's really what we do. And we're rebuilding the future. We are looking for ways to be relevant to the marketplace. We don't want our customers to buy from us because they have to. We want our customers to buy from us because they want to, because they want to do more of it. We don't want our customers to buy from us because they have limited access to other options. We want them to actually increase their size of wallet to what they do with CN. So that means reliable service. That means capital spending every year to be sure we have enough capacity to keep up with the economy, especially in places where the capacity might be tight. And also we need to digitize and automate more and more of our process so that our industry, the rail industry, can continue to compete favorably against the truck industry, against the water industry or the barge or vessel. And, they too are working hard on technology innovation, driverless truck maybe someday. And all these things, is top of mind for us in terms of what we need to do today so that we can continue to be very relevant to freight transportation in the years to come. Maybe, Peter, I'll stop it at that.
Yep. Thank you, JJ. Henry, over to you on Transurban.
Yeah, thanks. There's a lot of parallels actually between our business and the way JJ was just talking about his business, which is really interesting. Maybe if I throw out just a few numbers just to help people get a sense of what we are, particularly for those who don't know us so well. We're obviously a toll road. We're an owner of toll road networks, really in developed urban markets. That sort of sits central to the proposition of what we do. In terms of numbers, there are 21 toll road concessions across 5 markets, and that's predominantly focused on the eastern seaboard of Australia and North America. And then when we talk about North America, it's really just the greater Washington area and Montreal at this point. We've got a growing customer base, so we're reasonably large customer base, approaching 9 million customers across those markets. And we might get into this in some of the later discussions, but there's a potential for that to expand dramatically. As some of the more significant policy shifts come in over time, particularly around road use charging and things like that. But that just gives you a frame of the kind of business we are. Currently running about 2 million transactions a day or 2 million trips a day on our networks. The key, I think, as I said a moment ago, is that the markets where we invest are all urbanised markets with large growing populations and existing congestion issues that require continued infrastructure investment. That's fundamental, and that's why we are where we are. And Peter and many others on the call will know there's an immense amount of opportunity just in those 5 markets that we currently have. So we don't have a strategy where we're looking to push into other markets. For a number of years now, we've framed our strategy in broader terms than just roads, though, and that's really understanding the fact that we're just one piece in the transport puzzle, and that we need to be part of a broader multimodal solutions to congestion problems in the cities in which we operate. So we have a clear focus in our current markets, as I said, where we see a huge amount of opportunity. And the success of the business really has come from positioning as the partner of choice in each of those networks where we operate. So, to give you a sense of what that means in reality, over the past 5 years, we would have developed or acquired projects that would be worth, this number is a little woolly, I didn't actually grab the specific number before I came in, but it would be in excess of $20 billion worth of acquisitions or developments we would have done just in our existing network footprints. And we would see easily an equivalent amount of opportunity sitting in those markets as we look forward as well. So the idea of partnering with governments is absolutely critical to then how we succeed and drive value for this business. And then, much like JJ was talking about in terms of his business, that really then starts with efficient operations. So, ensuring that we keep the networks running as efficiently and as effectively as possible is critical. We put a huge amount of focus and effort into that aspect of our business, understanding that if we get that wrong, then the likelihood that we're going to get opportunities to pursue some of the broader, more significant development opportunities just won't manifest for us. And then, beyond that, I think we've developed a much more compelling proposition around a broader stakeholder footprint for our business. So if you went back 10 years in our business, you'd see a business that was probably operating more like a B2B business, focused very much on its investor base and its government clients, looking to put big wicks of capital to work and effectively then sit on it and find the next opportunity. We've really transformed, and a lot of that's been externally driven pressures that have forced us to transform into a much more sophisticated business capable of understanding customer and community needs, and then how we engage around those and address the issues that come up in those groups. And in doing that, then we present a more compelling opportunity to then partner with governments. And the key is that we're in a highly competitive environment. Sometimes, that's not well understood. We often have a term monopoly that's attributed to our business, but for those who know us well, we're far from a monopoly. And each new opportunity is often very hotly contested. And there are plenty of recent examples in Australia and North America that show that. But we've had probably a higher success rate in being able to develop some of these opportunities by virtue of how we've been able to think about the broader proposition. So I think that sits right at the heart of our success.
Great. Thanks, Henry. Appreciate those introductions to your business for those that perhaps are less familiar. You set up a strategy and a plan, and then something like 2020 happens, and you have to adapt. And I think it's been great to see how your companies have adapted to the crisis that we've been put in front of in the last 12 months. Can you talk to us about what made your businesses resilient through this period? What characteristics do you think set you up to both weather the storm and then recover as quickly as you have? If I can start with JJ.
So, the rail industry has a history of facing some storm coming at us, whether the economic storm, that case was COVID, some of the time it's a financial crisis, some of the time it's just a challenge with nature, harsh winter and whatnot. So there's we by essence, we're an operator, and we're a good operator. A lot of people at CN are operator, and therefore we have an experience of dealing with crisis. This was a crisis. It came in fairly quickly. We had a sense it might be coming in because we do a lot of trade with Asia, especially China. We have also freight forwarders in China who went under, basically our office in China started to deal with COVID earlier in the year. So we had a sense that this may be coming this way. And how they were dealing with COVID, in January, February, maybe gave us some hint of what we needed to do. But quickly, we ramped down costs. We had to do unfortunate layoff. We parked a lot of assets. We basically, had to basically adapt the plant, the big factory, if you wish. We had to adapt the right size, the big factory to how much business there was. And our customers had to do the same thing quick. And then, from mid-March to the lows of, let's say, the month of May, we could see the gross ton mile, which is a measure of traffic that we track, workload that we track every day, that was coming down. And we could see that geographically by segment of activities where it was coming down. The biggest hurt was the energy industry. The energy industry, because if people stop going to work, if people stop to fly, there's not a whole lot need for refined product. Crude demand went down. You could see the price of energy, refined product, frac sand for drilling of natural gas or oil to collapse. So these business came down very fast. The port business, which has to do with consumer, which was in his home, it was not obvious early days. Many retailers also, it's not obvious to them that actually people would potentially spend as much money as before COVID, but they wouldn't spend it differently. They wouldn't spend money on restaurant or bars or hotel or travel, but that disposable income went to consumable, and these were mostly generated freight. And so when the traffic started to come back in late June, mid-July, basically at that point, there was a backlog of product waiting. The inventory in North America were down, partly down because the first phase of COVID in China, the factory shut down and product wasn't coming in. And the second phase, when COVID hit in North America, the retailers stopped ordering. And then we had this tsunami, a V-shaped type recovery in July, which was quite a challenge because we had to recall people back to work. We're highly unionized. Our workers weren't too sure about whether they really wanted to come back to work right away. So they all used up their maximum number of days of callback. So the month of August was actually a challenging month from a available of labor. And then things came back together during the fall. So very sharp decline in the overall demand, very sharp coming back when anything has to do with housing starts, renovation, anything around the house. And the manufacturing sector, even though it was hit early days, it came back fairly strong. So we basically had to adapt to this sort of V shape. And then on the other side of where we're at right now, the economy, the energy, I'm sorry, haven't really recovered that strongly. So we have a somewhat different book of business today. Reason being, we don't move any jet fuel. We don't move as much diesel. We don't move as much gasoline. We don't move as much frac sand for drilling for oil, even though those things are slowly coming back. And for obvious reason, if people don't drive, then all of these things have a different market. So, and along all of that, making sure that our employees felt safe, that they were being looked after, that they were being recognized as essential services, essential worker, keeping the Canada-US border very fluid, making sure actually our employee can cross the border to run train back and forth. A lot of things that some of those we had to go through during 9/11. Some of those we had to go through during the economic crisis in 2009. But as an operator, I think you have to be good at these things, because these things will happen and they will happen again. So this would be just some example of how, kind of what was the last, in fact, 12 months, because this time last year is when it's really started to hit Canada, United States.
Yeah, that history of crisis and issues to deal with, certainly sets you up to tackle, the next one. Henry, Transurban, what are some of the resilience characteristics that came through?
Yeah, look, I agree. I hadn't thought of that point, but I agree with it. I think, we run emergency strategy scenarios constantly through the business in a range of different ways. And I suspect that just having that sort of cadence and familiarity within the business meant we were able to move into a fairly familiar posture quite quickly to then methodically work through the challenge that had emerged through COVID. We formed a view, so that people, I think, already are forgetting how uncertain things were in that March 2020 period, when we really didn't know how deep the abyss was that we were staring into. And so we formed a view reasonably quickly that we wanted to hold the business in its current shape. We've spent a lot of effort in recent years building capabilities that we think will enable us to go after opportunities in the markets I was describing earlier. And we were very reticent about scaling that back in any way, because we would then see, further effort and time lag on the other side of this if we did pursue that sort of strategy. So we were very clear in getting to that position quickly, and then communicating that with the employee base, and being very clear that we weren't looking to downscale the workforce. In fact, we've actually probably increased our numbers through this period, not decreased, which runs counter, I know, a lot of other businesses that are out there. But it's certainly been a really interesting period. The other thing, I guess, is then in order to be able to do that, we needed to be able to move quickly to ensure that we had sufficient liquidity to navigate even the worst scenarios. And you might recall, Peter, I'm sure you're aware of this from your discussions with us, but we moved into the debt markets and quickly secured a couple of $2 billion worth of debt, which just gave us the confidence to then pursue the strategy I was describing a moment ago, because that really then gave us the buffer to navigate all but the absolutely most extreme scenarios. And so then we could confidently move forward with that plan in terms of weathering the storm. We're obviously fortunate, like a lot of infrastructure businesses, that we operate very high operating margins. So there's quite a lot of buffer before you start getting to sort of metal on metal with the operating costs. And we never really got anywhere near that in the end. But certainly in those early days, there was a decisive move to shore the security of the business up so that we could then move forward. And then the conversation became, okay, what opportunity will sit on the other side of this potentially, and are we ready, or do we need to be repositioning in any way around how that opportunity looks, either in terms of scope or timing. The other piece, which has become a bit of a recurrent theme for us, is then working through all of the different stakeholder groups and how we're managing the various issues that might come up for them. So, for investors, obviously, it was disruptive to our strategy of paying distributions, and we've had to be very clear about how that's altered. But we've been quite decisive in moving to to a sort of restated position of saying, well, we're going to continue to pay out operating cash flow from this business, but we moved away from the capital distribution support that we'd previously been putting into those. You know, for employees, we talked about certainty of employment very quickly. You know, we continued to look at ways in which we needed to augment our support into more distressed elements of the community and the customer base. And I think we might talk about a little of that in a moment, but that was a huge effort within the business as well. So that was a sort of multifaceted response that ended up coming out of the more structured, detailed planning that we moved to very quickly.
Great. Thank you, Henry. Let's dive a little bit deeper on the volume side. At the end of the day, both railroads and toll roads volumes are the core of the business, at least in the short term. Can we talk through a couple of examples of what surprised you, both on the upside and downside, through the last year as it relates to volumes? JJ?
Yeah, so on the volume side, I wouldn't say that we were surprised, but the one segment that stayed strong and stronger than that maybe we would have thought early days is the container business. Coming from the ports, and to the point I was making earlier, consumers' behavior and consumer, where they put their money, disposable income has shifted, and a greater amount of it went from buying services to actually buying goods, and goods is great business for container business, for railroad. CN is basically a big asset that's part of an ecosystem of supply chain. When you bring goods from overseas, whether the Atlantic coast, Gulf Coast, or Pacific coast, what customers really pick is an ecosystem of a gateway. They pick an ocean shipping line, they pick a port of entry, they pick a terminal operator, and then they pick a railroad behind that to get to where the people really live. Railroad goes to where people live. That's where the container business is, the big city. For the case of CN, the Midwest and Central Canada. So you can get to the Midwest and Central Canada from any of the three coasts, from many ports. But the port business today, especially on the West Coast, Canada, US, is still very busy, has been extremely busy since August. At the Port of LA Long Beach, there's still queuing a vessel. So it's a sign of how much maybe the supply chain got itself empty while when the Chinese factory were closed, and then when the retailer stopped ordering for a while, and then some of the product that people consume just went off the shelf like no tomorrow, because they were items that in normal time would not sell at that same rate. So some supply chain are still trying to replenish themselves, and I also get the sense that some retailers are also counting on a solid spring, where despite the progress on vaccine, they think that the amount of money from consumers going into goods versus services will still be fairly high. So the port business has remained that shift in hindsight is easy to understand, where people have invested their money, but it was not obvious back early spring and last summer. And I think it was also not obvious late fall that this thing will still be ongoing as we are here early March. Going back to some of the comment that Henry was making, we too went also to the to go and get some money during the COVID time to be sure that we had a robust balance sheet just in case things were going to lock down even worse. One thing we did last year, crises come and go, and they always come and go. So last year we maintained our capital plan as usual. We started the year before COVID with an intention of investing about 19% of our revenue, 20%. And we did that because right now demand is strong. It may be somewhat different than the demand that we had pre-COVID, meaning energy is less, consumable is stronger, but capacity is required at all time. And any of us who are involved in infrastructure takes time to build. It takes time to permit, and it takes time to finish the project. So you should avoid slowing down during a crisis, because after that, when things come back, it's lesson from the past is you might be left behind if you haven't kept up your capital plan. So we maintain the capital plan, and we're very happy with that. And in fact, this week at our board meeting, we've also sanctioned a number of items that are meant to be prepared for what we think, and I think many other people think, will be a strong economy in North America the second half of this year in 2022.
We got Peter, I dropped out a moment ago just then as well, JJ, so we might have lost Peter.
That's right.
Maybe I'll jump in just while Peter
Yeah.
rejoins. Look, it's been really interesting for us too. Obviously, we have deliberately invested in urban networks over the years as the underpinning to our strategy, predicated on the idea that urban networks are more resilient to economic shocks than intra-urban networks. And so the really interesting thing was that COVID obviously dramatically impacted the urban environment just as much as it did any other environment. And so that was uncharted territory for this business in many respects. And then if you look at how that played out into the numbers, we were seeing 50, 60, 70% year-on-year declines in our volumes across the eastern seaboard of Australia. And it was actually a little deeper in America, where we run a slightly different model, which has a little bit more cyclicality to it and discretionary spend to the express lanes. So it was a very, very significant impact. The interesting thing for us was, and one of the things our traffic modelers are constantly trying to do, is then map the gradient of the recovery curve effectively, so we can start to plan off that. And they've done a reasonably good job, but everything has obviously tied to the easing of restrictions. So in the markets where we've seen a progressive easing uninterrupted, we've seen a very good recovery. So, Sydney and Brisbane in Australia are the two examples of that, where we're effectively back to year-on-year almost positive growth now. Where we've seen sort of halting closures or shutdowns of cities like we have in the city I'm in today in Melbourne, it's been a far more bumpy ride back, and indeed we're still in negative territory year-on-year, even off a weak comp. But I think the interesting thing is that each time the cities open up now, we're seeing a greater propensity for people to quickly move back in, which I think would anecdotally suggest that people are just sick of being tied to their homes, working from their homes, and so they look to re-engage as much as they can quite quickly. So that's a theme that hopefully will continue to play out as the world rolls out the vaccine, which hopefully will then open up broader sort of opportunities for movement. There's some really interesting parallels to what JJ was describing there around the freight networks. So we obviously have a component of our traffic tied to freight, and that's been far, far more resilient through this period. So, if I give you an example, in the first half of financial year 21 for us, down here in Melbourne, the truck traffic was down circa 60%. The total traffic was down circa 60%, but the freight volumes were only down 13%. And that's a sort of parallel we've seen across all of the networks, and there's a logical underpinning to that, and that goods particularly were still moving around the networks relatively unencumbered, and indeed it was an important part of how the cities continue to function even when people were more constrained in their own movements. So that's been a pleasing sign, and certainly something that I think has provided a little more resilience to an otherwise fairly torrid tale as the cities were shut down. The other thing that we're grappling with now is what the enduring changes will be around people's movements and how people work going forward, in light of the fact that obviously the world has had its eyes open to a slightly different way of doing things, with the shift towards flexible work arrangements and things like that. And we've done quite a lot of work, some quite detailed surveys that have some fairly robust data now underpinning them. And that suggests that what we're seeing suggests that the vast majority of people will return to office-based work, and they have an intention to do so. So just under 90% of people we've surveyed around that, and these are surveys involving thousands of people across Australia and North America, we will see the vast majority of the people return to office-based work, but the way in which they return may differ, and there's a clear appetite for people to access more flexibility in how they work going forward. And for us, we actually see some opportunity in that. The opportunity comes through pushing people out of the peak periods and driving better capacity utilisation on the network through these periods where there's latent capacity that to this point in time hasn't ever really been effectively used. So we're thinking about how we can partner with governments at the moment to drive that as well.
Right, thank you, Henry.
Yeah, we got you back. Great.
Yeah, technology, great. So I've got another question here from my JJ, which is Jessica Jowning, a railroad analyst, to you, JJ. Without doubt, the PSR, precision scheduled railroading journey, has been positive for the railroad industry. However, it does seem that an obsession with achieving the lowest operating ratio could have unintended consequences. What are the pros and cons of focusing on OR as a measure, and how do you think about efficiency?
Yeah. So precision schedule railroading and operating ratio are typically associated to one another. Precision schedule railroading is also, I'd say at this point, is a mature strategy in terms of operation and what it could do as the industry. It started at CN, but then other railroad North America have adopted it. So eventually you get to the point of diminishing return. And eventually you get to the point where increasing your profitability bottom line by precision schedule railroading and pushing it to too far of a limit, what you do is you start to compromise growth, profitable growth. So that's the journey that CN is on, is right now, is to evolve from the benefit that we've been able to get over the many years since since basically early 2000 of the schedule railroading, precision schedule railroading, which really gave us good asset utilization. You're sweating your asset, you're reducing your costs, you're becoming more and more efficient, and then you have a lower cost. But once you have that lower cost, you need to start to pivot to, I have a very unique asset that nobody else can replicate. So how do I bring more business, profitable business to this asset so the asset is more valuable? And this is where at that point, you need to pivot from focus on operating ratio to basically profitable top line growth, increasing your total earning, and then focusing on your free cash flow and your EPS and your return on invested capital. And at CN, I think for over a decade now, the operating ratio is no longer one of the element of our incentive at the management. Our management incentive are more toward these other things I mentioned: profitable top line growth, free cash flow, increasing the operating income. So increasing the things which makes the company bigger, the market cap bigger, as opposed to focusing on a specific index, which by and large, an operating ratio is a byproduct of everything else I mentioned earlier. When you reach that byproduct, the optimal point is really to get into really put more business on your asset, which is unique, that nobody else can rebuild or nobody else can actually buy. The other point also about precision schedule railroading, it was conceived at a time where technology was not as prevalent, not as cheap, and not as understood or user-friendly as it is today. Here we are 15, 20 years later, we can automate a lot of tasks. We can digitize process. And as an old industry, or in a company who's been in business for a long time, November of last year, last year was our 100 years anniversary. We really need to get on with how do we digitize our process to go from precision schedule railroading to what I would call digital schedule railroading. So we automate every process that we can, as we should. And that's really the next journey of controlling costs and improving safety and asset utilization. And on the customer relationship side, our customers, like it's during COVID side, all of us consume, all of us get basically accustomed to getting product delivered to our door to Amazon, and we can track our shipment on our cell phone. Well, that's not quite as easy when you buy freight. Funny enough, you buy one parcel box from Amazon, it's easier to track than if you buy a full truckload or a full container load of stuff coming from Asia. So we need to digitize the relationship that we have with our customers on the consumer side, because in our quest to become more and more relevant to the customer, to have more and more customers who wants to buy more of their services on our ecosystem, the ecosystem that we're part of that supply chain that we're in, we really need to automate and digitize this process as well. And that's not necessarily part of the historical part of PSR. So PSR has run its course. It still has some in it. We need to really bring technology and digitation into it. We need to bring in the customers into it. And we need to lever this asset and this cost base to really compete much harder with the freight, which is on the highway, and compete much harder with other railroad and other gateway to the hinterland.
Yeah, that's great. we need another acronym in the railroad industry. So DSR sounds like the way forward. Have you trademarked that yet?
No, but we thought we needed a way to link back to, we maintain the strength and what PSR can do, precision scheduled railroading can do to your cost and your asset utilization, and adding to that what technology and digitization can do to a big manufacturing site like we have, right? We have so much asset that I'll give you an example of our carman. So what is a carman at CN? Is a person who actually inspect equipment and fix equipment. We want to be over time that they no longer have to inspect, they only fix. And the inspection is done by technology. Technology will do the inspection of the rolling stock. Technology will do the inspection of the network itself. And our people who are in mechanical department, their job will become to fix when technology actually create a work order that says, this piece of equipment on this rail car needs this piece to be fixed, which some of that in the past was done, by visual inspection. Same thing with the network itself. So we need to get to the point where more and more of the work that could be automated, preventive maintenance, for example. And I know, people know that there's a lot of effort about driverless truck, and there is some driverless train in Australia. So that part also at some point needs to get to the point, like an airline, where the pilot actually don't touch the equipment very much. Actually, a plane is more fuel efficient and is actually more efficient if you remove the human intervention. You let the computer do it, and that's where some of our locomotives are down that path too. And more of what happened with that locomotive is actually coming from a software that knows the weight of the train, the speed of the train, the track speed. How many trains are before, how many trains are behind. Do you want to slowly slide in the meet, or you want to speed it up? And most of these things now could be optimized through basically software and automation, as opposed to rely on an engineer who would play with a throttle. So yep. Huge potential on that. And I didn't talk about ESG and carbon footprint, but that's another big areas of future potential, is how do we take carbon out of a supply chain and do that in a way that we do it before we've been asked to do it.
Great, thank you, JJ. I want to change tack a little bit to the working from home impacts, Henry. Working from home could have some long-term structural impacts on traffic. There's debate still going on about that. But it also presents challenges for employees, having to be set up, and there's cultural impacts there. I also think about the amount of M&A that you mentioned earlier that the Transurban has done over the years. With that work from home environment, with transformative M&A, I guess, how do you maintain an employee culture in a business like yours?
Yeah, it's a really good question, and I don't think we're unique in the challenges we're dealing with there. Obviously, every business is grappling with this transition that we've had to rapidly make through 2020. There's probably three facets to it, I guess, that I think about. The first was, how ready were we when it hit, from a technology and just a practical logistical perspective. And I think we were reasonably fortunate in that we feel like, with the benefit of hindsight, we were quite well positioned. There'd been a very active conversation shifting to workplace flexibility in the business that had been ongoing for a few years, and that had driven then some technology shifts around our ways of working. And Peter, you've been to our offices. We've got quite a dynamic office environment, and what that belies is a broader shift around how we were asking the workforce to engage with the business and conduct themselves day to day. And I think that led to probably an easier transition than it might otherwise have been, particularly if you caught us a few years earlier on something like that, which meant that we could move reasonably quickly just from a practical perspective and have people equipped with the right technology so they could connect. The second piece was then probably a more significant one around the transition in leadership, approach to leadership across the business in terms of all leaders and how they took their roles up, understanding that there were different challenges that would be presented through the workforce. And that's actually a broader conversation for us anyway at present, but there's been a very active conversation around that. testing people, challenging the people leaders around how we're engaging the teams, just to make sure that we're on top of any emergent issues that might be coming up. And I think that's been a helpful sort of facet to probably aid in the transition for the workforce through this period. So they're probably the two sort of practical things. And then the third element ties back to that broader strategic sort of conversation we were having around certainty of employment and prospects coming through this. So we were very, very clear early on talking about the fact that there was no intention to downsize, and we're obviously fortunate. I recognise that we're in a fortunate position in being able to make that pronouncement to the workforce, but we made it quickly. And then the conversation turns to opportunity. So we could keep people energised with the fact that we saw opportunities. So the business, notwithstanding the very significant P&L disruptions that we were weathering through 2020 as the cities shut down and then began their progressive march to recovery, we could see through that, and we can see opportunity. We still see it today. And so we were able to maintain a reasonably energetic conversation with our broader employee base. And that's crucial in terms of maintaining, the key talent we have to then drive towards some of those opportunities that I was talking about earlier.
Great, thank you. One of the topics of the moment, I guess, is the rise in inflation that we're seeing, or at least inflation expectations, I should say, and rising 10-year bond yields, and I guess for long duration cash flow generating assets that can be a challenge in the short term. But I wanted to dig into that ability to raise price, which is a very attractive component, we feel, of both of your businesses. Can you just walk us through, JJ, first, as you're raising price, what do you need to provide, the customer, to justify that price increase? And when some customers are hurting at the moment, how do you balance that out?
Yeah, so good question. And price is, in an asset-intensive business like ourselves, price is very much part of success, and it's also part of how you maintain a good operating ratio. A good operating ratio is as much about the price and the quality of the business than it is about your costs. So the mindset that we have at CN for many, many, many years is to do what we call steady inflation plus pricing. So we look at inflation. Inflation to us is what we would call rail inflation, net of fuel. Any fluctuation in the price of diesel, which is a big purchase, big cost for the railroad, is transferred to the customer through a surcharge. So it fluctuates back and forth with a 2-month lag. So we just pass on that inflation or deflation to our customers. Right now it's a deflation because diesel is cheaper than it was a year ago, at least last fall. And on the product price, this is what we always price. We measure same store price. I got this sales this year, the same sales than last year. What's my same store price gain on that? And that same store price need to equal or be slightly ahead of rail inflation. So we really live off the compounding effect. If every year we can gain 0.25% or 0.5% above rail inflation on the selling price of the service versus my cost, that's success. And that's very, very key, fundamental to our industry. Some customers, obviously, from time to time, go through financial difficulties. I'd say most of the business that we do at CN, the one I described earlier, actually, most of our customers have been financially strong last year. They may have been like us, not too sure what the world was going to be like when they were looking at mid-March and early May. But most of that business, manufacturing, natural resource, definitely consumer goods, came back. The energy has not, but typically energy company are fairly robust. They have huge balance sheet, and they're basically reinventing themselves. So the pressure from the customer is not coming so much from financial distress. It's coming from the basic of marketing, supply, demand, and choices. Supply, demand, and choices. Year to date, our volume, I think, is about up 9% from last year. So the demand is strong. Overall, not in all segments, but by and large, is strong. And we started to hire people back again early fall last year, and we basically hire every month to replace natural attrition of worker as well as, increased business or prospect. Like right now, I said where we're up, and we expect the business to continue to grow in the second half and in 2022. So in reality, in a time like this where some segments are very strong, we also, in some ways, we do triage. We do not, to be able to provide a good, steady service, we should never sell more capacity than what we have. In our Western network, the capacity comes at a premium. The demand is actually strong enough that we could let the network become inefficient if we let the business coming at us that maybe want to come at us. So actually, we have to have commercial discussion, and in some cases by contract, in some cases by mutual agreement, of how much business we will do at a specific price for a specific account. And if you're going to be bringing more business than that, then we need to talk about it, as opposed to just bring it up. And we might be able to do it, or we might not be able to do it, or we might have to have a discussion about a different price for that business. And this is where you get, if you wish, competition between different commodities competing for the same track network, some competition between different. It's basically yield management. So as we are in a phase where the economy is coming back, some segments, frankly, have remained strong. I talked about consumer business earlier. Price is back to some of the basic of supply, demand, and capacity, and customers' choices of what they can get from other service provider.
Great, thank you, Henry.
Yeah, the price escalators or the price escalation mechanisms embedded in our concession agreements have been a huge focus for us even well before COVID, obviously, understanding that it's a potential point of friction, particularly with the customer base and the communities. And where that sort of led us to, in a more generic sense, is a push to drive better transparency, particularly around the value proposition to the customers. And the value proposition is strong when you look at it, particularly when you look at the relative sort of competing options that our routes might be compared to. So we've done a lot of work around customer offerings, customer communications to drive that. And indeed, we were in an environment for a time here in Australia, particularly as that wave of political populism kicked off, where it seemed like we were in front of a Senate inquiry every other month, talking to these issues. And in fact, it became an incredibly useful thing for us, because then we were able to sort of methodically lay the data out and talk to it and put it out in a way that was comprehended by a broader audience. So that's sort of the broader impetus. It's still a huge focus for our board. They look at it every time we write a new deal, looking carefully at the concessional arrangements and the pricing mechanisms that we're embedding within it, understanding that then is effectively the price for the duration of the concession, all things staying constant. And that'll continue to be a focus. It's still a frequent discussion that we have at a management level and a board level. Then if you look at the more specific situation that emerged through COVID, where we could all see more acute financial hardship emerging in pockets of the community and customer base, there was a very robust discussion amongst the management team here and the board around what we do. Do we move to adjust any of the pricing arrangements, or do we do something else? And when we weighed that up and looked at particularly your point, Peter, around the fact that we raised billions upon billions of dollars in debt and equity markets predicated upon this investment proposition and the certainty around that pricing mechanism. And then we looked at the disruption to that, combined with the fact that when we actually looked at the adjustments we'd be making potentially around, say, if you freeze tolls or something like that, you're providing sort of micro assistance, so give you an example. Down here in Victoria, a quarterly toll increase might be worth between 1 and 10 cents a trip on the network down here. So not really anything that's going to provide any material assistance to anyone, substantially disrupts the investment proposition, and therefore the business to continue to prosecute what is actually quite a valuable service offering to the community at large if we get it right. So we moved in another direction and really went down targeted customer support, and that was around this notion of toll credits to, in a blanket sense, to tens of thousands of people worth in excess of $10 million just last year alone. And that then meant we were able to put effectively free travel that was worth, in excess of $200 to the average recipient of it in the pockets of those who needed it. So initially it was all frontline workers and anyone whose employment had been disrupted. And then we continued on with the theme around supporting those whose employment had been disrupted. So that was reduced hours or loss of job. And then what we've done now, 12, 13, 14 months into this thing is transition it into a sort of BAU program that we put in place around supporting customers in financial hardship, which we call Linked Assist. So we've ramped up the amount of money that we will make available on an ongoing basis under that program in order to address that. And we've had incredibly positive feedback on this. We go out and survey whether it's actually having an impact and how it's perceived, and we've had overwhelmingly positive feedback on the program as we configured it.
Yeah, I think those targeted programs make a lot more sense to me, and pleased that you put that in place. It's a good segue into, I think, the biggest single risk for infrastructure investors, political and regulatory interference. And I feel like we're at this point now where things can go either way. Governments, are under enormous pressure, loaded with debt. They could react in a negative way against, some essential services. On the other hand, there's a huge opportunity there to work with governments and partner with them to create opportunities. Just like to talk you through how you're thinking about government relations and regulator relations at the moment, and where you can take advantage of the current situation, JJ.
So I would go back to the discussion we just had on price and the discussion we had earlier about we maintain our capital investment during COVID or during most recessions. So what government they need the trade to stay fluid. They need the railroad or asset to enable trade, not to prevent trade or become a barrier to trade. And they need us to continue to maintain the network, create capacity for the future, and provide the price that's reasonable to those who depend on it, right? So manufacturing, natural resource depend by large in what we do. So we need to have the capacity, and we need to be mindful of price to do it on a steady basis over time. Otherwise, we would attract re-regulation on pricing, as for example. So really, we need to be sensitive to what does a country need. We need to enable trade. We actually participate in joint funding program with the federal government or province with the port to create three-way funding to build up the supply chain at the port. So rather than, we partner with others in building what's going to be needed for the future. We do the same thing on the pricing side, is that whatever the supply demand balance is, you want to be mindful that what exists today, which is 6 large railroads in North America, is quite unique. It can only exist in an environment where the 6 large dominant railroad, and by and large, you basically have 3 duopoly, one in eastern US, one is in western US, and another one kind of the north. So in order to maintain the value of getting our return capital and our pricing, so-called pricing power, one has to remember that as you deal with the marketplace. And also one has to remember that if we don't invest every year to maintain the plant, and if we don't invest ahead, if we don't maintain the capital plant to have the capacity needed for the future, then eventually somebody will come in and help us out. And they have the power to do that. So when you look at your capital plan, when you look at your pricing, when you look at your maintenance program, it would be a huge mistake to think short term. It would be a huge mistake to drive your operating ratio or to increase your stock buyback at the expense of your maintenance program, at the expense of your capital program, because you'll get away with it maybe 3, 4, 5 years. And after that, you will lose the value. And when that value is gone, it's gone. You can never take regulation back out. So we really have to be good custodian of what we have and make sure that the intrinsic value of what we have stays intact. So you got to work with regulators. You got to work with government. You have to work with them. The next things that we're going to have to be focused on is how do we take carbon out of our supply chain? We can either do that very reluctantly, been pushed into it, or we could do it in partnership and create technology and the solution of the future and do that early on. So the long-term view, taking a long-term view of what we have and how relevant it is to the country, these things used to be owned by government, and these things used to be built by government. They transfer it to private sector, but the private sector still needs to meet what the basic of the need of the country are. And that's how we can make good money. And always remembering that these infrastructure, they are essential. And therefore, we have to provide the essential need of what is required at all times.
Yeah, we definitely agree with that long-term view. The pressure to deliver a quarterly earnings result, I think is not in the best long-term interests of shareholders. Henry, do you want to add to that?
Yeah, look, I agree with everything JJ was just saying. I mean, we've been living with this sort of political / regulatory risk now forever, really, Peter. And I think we all saw it ramp up significantly, a few years back with the rise of, a global wave of political populism and anti-corporate sentiment that emerged in almost all markets. We've always looked at our markets as being low political risk, and that's one of the reasons we're there. That's been an important facet that we consider in moving into each of the regions we're in. But having said that, we've seen political risk increase. There's no doubt about that. I sort of take another view on this sometimes, and I've seen this happen within Transurban. It's also made our businesses better, don't forget. I mean, if you think, I think earlier on the call, if you looked at our business 10 years ago, you were looking at a business that was behaving ostensibly as a B2B business, focused on investors and government clients, trying to develop major projects and get big wicks of capital into the network. That was sort of the model. We have an incessant focus now on customer, how we're removing friction points, how we're better demonstrating value to the customer in a more transparent way, how we're looking at our community engagement around major construction projects and managing the obvious issues that come up around that. We're infinitely better than we were even 5 years ago on that. And some of that improvement is almost certainly driven by the external pressures that have been brought to bear on the business to get better at it and to better understand these issues that come up around a broader group of stakeholders. So we're certainly better positioned. We still have a lot to do. And I think, to JJ's point, there are some rapidly evolving issues that we need to stay on top of and manage and be cognizant of, because you want to be out in front of them. You don't want to find that you're being told to do things. So, carbon's clearly one of those things in the environment, but there are broader things. I think the only other point I'd make is ultimately you have to be able to deliver something that the government can't deliver itself. And so you have to find ways to have a differentiated offering, an improved offering. So it means technology investment. It means being an early adopter of things that can help drive improved sort of efficiency. It means looking forward into the future around some emergent themes. We see some big shifts coming in policy and vehicle technology, and you even look to take our most recent bid that we were successful on around the Maryland Express lanes. That's a good example of evolving expectations of government and taking into account a much more multifaceted future view that we need to then accommodate in how we design up these projects.
Great. Conscious of everybody's time, this is my last question. We're going to talk climate change and environment. So both of you, your companies have made real progress on sort of scope 1 and scope 2 emissions, things that are in your control. I'd like to not only get some practical examples of things you've done there, but also think about scope 3 and what potential impact you could have on your customers, whether it be crude by rail or coal or fossil petrol engines for the toll roads, moving to electric. What sort of things could you do to help that as well? And I'm picking up a question as well for you, JJ. Hydrogen locomotives, maybe you can weave that into there as well.
Yeah. So we consume a lot of diesel because of the size of the company. Having said that, rail industry is much more fuel efficient than over the road. I think that's commonly understood. It's about 4 times more fuel efficient. Therefore, the emission is 4 times better. Because fuel costs money, and also because fuel generates CO2 emission, we've been on that journey now probably over 10 years to reduce our fuel consumption to become more and more fuel efficient because it costs less and it reduces emission. We are the most fuel efficient railroad in North America from freight, about 15% better than the average. And it's a journey that we're on to keep refining technologies and operating practices around how we manage these trains to continue to be more and more efficient and reduce the amount of number of liters per ton mile, if you wish. The next step of that is eventually we need to move on to different type of fuel. And what's really, in the sort of our 5, 10, 15 years journey is eventually increasing the amount of biodiesel coming in. So a diesel, it's actually a renewable diesel. These diesel today exist in North America, but the quantities are limited. So in order to make that happen, we have to work with our suppliers to work with them to make that possible. We also engage with companies who are thinking of building biodiesel plant to encourage them to build them in geographic location that would be conducive to the CN rail. So basically what I'm saying is rather than wait for biodiesel to become available and wait for it, we try to engage in a way to see if we can enable it to become available and to become available in a geographic area that would be useful to us. The next step after biodiesel and increasing the amount of biodiesel and improving the technology to make everything more fuel efficient is when you get into other source of fuel. And you mentioned hydrogen. There's really hydrogen and batteries. And both of them right now are, in terms of freight railroading, are really at the infancy stage. So there is a hydrogen locomotive that exists in Europe today for a small passenger train, meaning the tonnage that they pull is still limited. And same thing on battery locomotive. There's a few one that exists. The tonnage they can pull is still limited. So what we do in that space is, again, rather than wait for that technology to become available commercially, we would like to partners with those who build engine and those government, either province, states, or countries would like to help fund these things to help create development plan so that we can trial either an hydrogen locomotive that an OEM, a manufacturer would like to try either for local service, which is less tonnage, or mainline, which is huge tonnage. Same thing with electric locomotive. So it's really about, rather than wait for solution to become available that we can buy off the shelf from somebody who builds them, whether biodiesel or next generation of combustion, is for us to get involved with those who are thinking in a process of doing that so that we can actually enable that from happening, if we can, happen that in a way that would be favorable to CN, and also try to convince the regulators and society who wants us to do that, obviously over time, to also chip in the development of, so that we can actually meet the need that we have, the target that we have for 2030 and eventually 2050. To get to carbon free, we need to get to electric or hydrogen. And frankly, at this early days, we don't dismiss any option. I don't know if it'll be electric. I don't know if it'll be battery. I don't know if it'd be hydrogen. I think it's too early to say what's going to be the winning thing. You want to try what's available. You want to work with those who are willing partners to put money into it, including states and province, and then see what we can do with that. So we're not going to be building locomotive, but we're keenly interested to work with those who wants to put some money in the pot and try this out.
Thank you, Henry.
Yeah, I mean, we obviously have scope 1, 2, and 3 targets in place with that science-based target initiative, which is a sensible way of saying we've got targets in place that are in line with Paris. I think the one of the misconceptions around our business is, and probably there's a nuance I'll come to in a second, because the customer emissions aren't seen to be within the scope 3 emissions of our business, so they sit outside of it. That's something we're very aware of, and it doesn't mean we ignore customer emissions. There's quite a lot of focus now on what we do to help address that. But in terms of the scope 1, 2, and 3, we've now got a clear pathway to significant reductions on that 2030 timeframe, and I'd expect we'll hit our scope 1 and 2, several years in advance of that. And then the scope 3 is obviously a bit more challenging because then you're going into supply chain discussions. So we've initiated some forums and some direct discussions with the key suppliers there to get a pathway that we can get comfortable with to achieve the Scope 3 reductions by 2030. Then you get to, and to frame it up, we're talking in our business 200,000 tonnes Scope 1 and 2, 400,000 tonnes Scope 3, and then about 1 million tonnes of customer. So it's not in the scheme of large enterprises. They're not huge carbon emissions, but obviously still very important that we address them. So if you then look beyond Scope 1 and 2 and 3, which I think you can get quite comfortable quite quickly, that will be on top of the customer emissions, which are obviously larger than the other three components. I've always thought we have a natural tailwind, much like JJ was describing there, around a shift to electric vehicle technology, which we see coming. It's probably a little more delayed than we were hoping, particularly in Australia. We're a little bit behind here in Australia in terms of the uptake of EVs, but that will come. And on that 2030 to 2050 timeframe, where we've made commitments to net zero, that will obviously be a significant factor that drives through the customer emissions and helps reduce those. We've got a very active program at the moment around what we can do in the intervening period. We're just stepping up to encourage customers to make the transition, and also ways in which we can encourage different use of those who are still driving combustion engine vehicles. And so there are ways in which we might be able to assist in terms of how vehicles are being used, and we're looking at some programs on that at the moment. The other piece is then, which is probably one of the more significant things we're currently doing, is in the design of the infrastructure itself. So a huge amount of effort goes into understanding the impacts of design on potential emissions that might come up from carbon from combustion vehicles using our network. And there are things like, the obvious one that you can grab hold of and understand quite easily is, the gradients on the roads, reducing engine labouring. Those are things that we have changed significantly. And if you look at an older asset like CityLink down here in Melbourne, which has very significant gradients coming in and out of Byrne Tunnel, compared to, say, one we just opened in Sydney, the 9-kilometre North Connects tunnel, which has very, very gradual gradients through the whole thing, that actually has a very significant impact on the carbon footprint that comes off those from customer emissions when you look out over the decades that we'll hold that concession for. So that's one facet. And then materials is obviously another huge component, which the world's getting better at, and we're a beneficiary of that as we work that into our design and build.
Yeah, no, love North Connects. I think I've been a decent share of traffic on that road the last few months. Look, really appreciate the Q&A that's come through online. I feel like we've weaved a lot of those questions through in the discussion. So I just wanted to thank JJ and Henry for the generosity of your time. We've covered a whole range of issues that have been tackled well, and thank you.